Building credit, understand all the credit jargon. Imagine trying to buy a home without knowing what credit terms mean. It can feel like navigating a foreign language. Today, we're going to break down the most common credit words so you can confidently manage your financial health and get your dream home. First, let's talk about credit limit. This is the maximum amount you can borrow on a credit card. For example, if your credit card has a limit of $1,000, you should aim to keep your balance below $300. Staying under this limit helps keep your credit score healthy. Next is credit mix. This means the different types of credit you have, like credit cards, personal loans, or a mortgage. Having a variety shows lenders you can handle different kinds of debt responsibly, which can boost your score. Credit monitoring is a service that keeps an eye on your credit report. It alerts you if there are any changes or suspicious activity. This is important because catching errors or fraud early can save your credit history from damage. Your credit report is a detailed record of your borrowing history. It shows your payment history, current debts, and any times you asked for new credit. Lenders review this report to decide if they will lend to you and at what interest rate. Your credit score is a number usually between 300 and 850. It summarizes your credit risk. The higher your score, the better your chances of getting approved for a mortgage and receiving lower interest rates. Credit utilization is how much of your credit limit you are using. If you have a credit limit of $1,000 and owe $300, your utilization is 30%. Keeping it below 30% is best for your score. Debt-to-income ratio compares your monthly debt payments to your income. If you earn $1,000 a month and pay $1,000 toward debts, your ratio is 25%. Lenders prefer this to be under 36% for mortgage approval. Default happens when you do not meet the terms of your loan or credit agreement. Missing payments for more than 30 days can lead to serious consequences like losing your home or vehicle. Delinquency is when your payments are late, usually more than 30 days overdue. It can stay on your credit report for up to 7 years and makes lenders less likely to approve you for future loans. Annual percentage rate is the yearly cost of borrowing money, including interest and fees. For example, if you borrow money at a 15% APR, you will pay 15% of the loan amount each year in interest and fees. Billing cycle is the period between your credit card statements, typically about 28 to 31 days. After this time, your lender sends you a statement showing what you owe and your payments. Principal balance is the original amount you borrowed, not including interest or fees. Paying down this balance reduces your debt and can improve your credit standing. Interest rate is the percentage charged on your principal balance for borrowing money. If your interest rate is 10%, you pay 10% of your balance each year in interest. Balance transfer means moving debt from one credit card to another, often to take advantage of lower interest rates. For example, transferring a balance to a card with a 5% interest rate can save you money. Credit bureau refers to agencies like Equifax, Experian, and TransUnion. They collect and keep your credit information, which lenders check when deciding whether to lend to you. Credit risk is how likely you are to repay your debts. If you have a good credit history, lenders see you as low risk, which helps you get better loan terms. For Asian American homebuyers, understanding these terms is key. Building a strong credit history can open doors to better mortgage options and lower interest rates. If you are new to credit or have limited history, responsible use of credit cards and paying bills on time can help you grow your credit profile. Monitoring your credit report regularly helps catch errors or signs of fraud early, protecting your financial health. With clear knowledge of these words, you can make smarter choices, navigate the home buying process more smoothly, and work toward your goal of owning a home confidently.